So let us continue with fundamentals of base erosion and profit shifting plans. The plan number 6 is to give preventing the treaty abuse. Okay, we have learned this word treaty abuse while discussing the capital gain chapter. You know that if this is India and if you invest in India from USA, taxable in India. This is taxable in India. If you invest from Canada, taxable in India. If you invest in India from Dubai, taxable in India. But if you invest in India from Mauritius, not taxable in India. Okay, why? Because India-Mauritius treaty was in such a way that the capital gain should not be taxed in India, it should be taxed in Mauritius, whereas Mauritius government was not taxing this particular capital gain. Meaning thereby it was the most profound double non-taxation situation. Neither India nor Mauritius were taxing this particular transaction. So what many people have started doing, they started opening one basic office in Mauritius or one shell company, a ghost company, a paper-based company. Not in legal sense it will be there. Okay, in real sense it won't be there. In legal sense it will be there. Just a registration, and they will bring the investment in India. Not only that, some of the rich houses in India, they went to the Mauritius and they brought investment from Mauritius to Indian market. This is what you already know. We have discussed this lot of time in capital gain chapter. So don't you think this is a treaty abuse? So why it is called as treaty abuse? So treaty was signed for Mauritius people, but unwanted people are also taking, in fact people who were not intended, they are also taking the undue benefits of this treaty. So we have to control this. How we have controlled? So in 2016, Arun Jaitley sir have actually amended the treaty by neglecting this. They said no, now capital gain earned in India even through Mauritius route will be taxable in India. Okay, it will be taxable in India. Now you will think, sir, if it has become taxable in India, then definitely people will not do this. No, my dear friends, still people are doing this. Why? Because the new treaty that we have entered with Mauritius says, so the tax in India should not exceed 50% of tax rates in India. So in India, if the tax rate is, say for example 20%, then Mauritius people will pay maximum 10%. In India, if tax rate is 10%, then Mauritius people will pay maximum 5%, because the tax rate for Mauritius people should not exceed 50% of tax rate which is applicable in India. So still there is a treaty benefit or treaty abuse possible to take the benefit of this kind of concessional tax rate. So we have to control this. How we have controlled this? So we have said now you need to check whether the companies which are coming to India from Mauritius are actually having some business activity, some commercial activity in Mauritius or not. If they are only paper-based company, they will not be eligible for this benefits of treaty. Minimum standard, OECD minimum standards, given the risk to the revenue pose. So we have to check the risk and revenue ratios. By a treaty shopping, country have committed to ensure a minimum level of protection against the treaty shopping by including their treaties. The combined approach of limitation of benefit and principal purpose test. So we have we have adopted two tests. Limitation of benefit. So we have to give the limited benefit to the limited people. Apart from that, why did you come to Mauritius? What was your actual purpose of incorporating company in Mauritius? Why not any other country? Why not directly from why are you bringing investment in India in two-step model? Your country to Mauritius, Mauritius to India. Why can't you directly bring investment in India? So this is the principal purpose test. If principal purpose was only to abuse the treaty, obviously benefit will not be available. The principal purpose test rule alone or limitation of benefit rule supplemented by the mechanism that will deal with conduct financing arrangement not already dealt with the tax treaty. So they said do something, bring at least LOB rule or principal purpose test rule in your country. So LOB clause incorporated in Indian tax treaties. Okay, we have not incorporated in Indian Income Tax Act, but we have incorporated this clause in Indian tax treaties now. Okay. So India-Mauritius tax treaty, they are giving you one example. You don't have to remember this example. Just for your understanding, we are reading this. On 10/5/2016, India-Mauritius tax treaty was amended. For the first time in the history, it has been provided that capital gain from the alienation or transfer of shares acquired on or after 1/4/2017. See, not before share, not original share. This is prospective amendment. in a company which is a resident in India may be taxed in India. Okay. The tax rate of such capital gain arising from 1/4/2017 to 31st March 2019 should, however, not exceed 50% of applicable tax rate on capital gains in India. So this is also benefit. Okay. LOB clause provide that resident of a contracting state, Mauritius, shall not be entitled to the benefit of 50% of tax rate. So they will not be entitled for 50% tax rate applicable on transition period if its affairs are arranged with the primary purpose of taking advantage of the concessional rate. So the primary purpose was to take the benefit of the treaty, then we will not give you this concessional rate. The actual rate of India will apply. A shell or conduit company claiming to be resident of the contracting state shall not be entitled for this benefit. Shell companies means paper-based company, they will not get benefit. Shell or conduit company is the legal entity falling within the meaning of the resident with a negligible or nil business operations or with no real and continuous business activities carried out in the contracting state. So they have just incorporated a company, they are not actually doing any business in that country. In Mauritius, they are directly doing business with India. LOB clause in India-Singapore Treaty. So India-Mauritius Treaty is equal to India-Singapore Treaty. Okay, the same clause is also incorporated in India-Singapore Treaty. India-Singapore Tax Treaty has been amended to provide that capital gain on alienation of transfer would be taxable in a similar manner laid out in India-Mauritius Treaty subject to the limitation of benefit clause. The transition period benefit. Transition period means this 2 years benefit, no, 17-18 and 18-19. This benefit is also similar to the contained in India-Mauritius Treaty. That 50% limitation clause is again same clause. Thank you.